Question 1. A company intends to offer tokenized shares to U.S. investors through a blockchain-based platform. They plan to rely on Section 4(a)(2) private placement exemption and require token holders to be accredited investors, but advertise the offering publicly. Which issue arises from this structure? A. Public advertising invalidates the Section 4(a)(2) exemption by constituting general solicitation. B. Tokenized shares automatically qualify as securities under the Investment Company Act. C. Blockchain issuance methods exempt the offering from SEC review. D. Accredited investor requirement eliminates all compliance obligations. Correct answer. A. Public advertising invalidates the Section 4(a)(2) exemption by constituting general solicitation. Explanation. Section 4(a)(2) permits unregistered securities sales to sophisticated investors, but general solicitation or advertising disqualifies this exemption unless paired with Reg D Rule 506(c) controls. Even with accredited-only rules, public marketing makes it a public offering requiring registration or reliance on a compliant exemption. The involvement of blockchain tokenization doesn't override these statutory rules. It is a common error to assume that technical innovation circumvents substantive securities law requirements. Question 2. An investment fund is designed to generate returns from tokenized real estate deals. It markets to non-accredited investors but seeks to rely on Regulation D. What is the core legal deficiency? A. Reg D prohibits token-based securities. B. Regulation D prohibits derivative-based investments. C. Reg D requires that all purchasers must be accredited investors, except under Rule 504. D. Reg D mandates fundraising only through intrastate offerings. Correct answer. C. Reg D requires that all purchasers must be accredited investors, except under Rule 504. Explanation. Reg D's most widely used exemptions, Rules 506(b)(c), require all investors to be accredited, or a limited number of sophisticated non-accredited investors. If the fund is marketing to non-accredited individuals, it cannot rely on these exemptions. Offering tokens doesn't change investor qualification rules. Non-compliance risk includes rescission rights and SEC enforcement actions. Question 3. Ms. Garcia, CFO of CryptoRealty Inc., discovers the firm's tokenized security platform has allowed trading before filing required Form 8K disclosures for a material M&A tender offer. What must she do under SEC rules? A. File a late 8K as soon as possible and consider suspending token trading until disclosure is complete. B. No action necessary, since token markets are exempt from 8K requirements. C. Pursue a Form S-1 registration immediately and ignore the 8K requirement. D. Issue a press release and delay SEC filing for 30 days. Correct answer. A. File a late 8K as soon as possible and consider suspending token trading until disclosure is complete. Explanation. Form 8K triggers apply when material corporate events occur for a registrant. Trading around an undisclosed M&A agreement is a violation of Regulation FD and 13. A. Reporting obligations. Ms. Garcia must promptly file the 8K. Form 404 requires current disclosure, and consider halting trading to prevent further Section 10B/Rule 10b-5 exposure. Token markets are not exempt from these core reporting rules when dealing with registered securities. Question 4. Which behavior constitutes classic spoofing under Section 9(a)(2) of the Exchange Act? A. Submitting a large buy order at a remote price and canceling it immediately to create the appearance of demand. B. Posting false company news to a chat forum. C. Buying an ETF and simultaneously buying its underlying stocks. D. Short selling without disclosure. Correct answer. A. Submitting a large buy order at a remote price and canceling it immediately to create the appearance of demand. Explanation. Section 9. A.2. Targets entering orders with no intention to execute in order to trick others about market depth or price levels. Classic spoofing. The other options may involve fraud or manipulation, but do not fit the statutory text. The SEC and CFTC have enforced heavily against spoofing in recent years. Understanding nuanced order book deception is critical for advanced exam takers. Question 5. In the SEC's Howey test for investment contracts, which of the following is most critical to establishing a common enterprise? A. Whether the promoter is a citizen of multiple states. B. Whether there is horizontal or vertical commonality tying investor returns together. C. Whether profits are based on real estate activity. D. Whether there is a voting mechanism embedded in the security. Correct answer. B. Whether there is horizontal or vertical commonality tying investor returns together. Explanation. Common enterprise can be horizontal, pooling investor funds, or vertical, relationship to a promoter. Profit expectation and efforts of others only matter if investor success is tied to a shared pool. Voting rights do not defeat or satisfy this prong. Correctly identifying horizontal-vertical commonality is critical in advanced securities law analysis. Question 6. Mr. Anderson, a director at TechToken LLC, hears that an investor used insider information about a pending SEC enforcement order to liquidate positions. The investor was a tippy. Under Dirks and SEC guidance, what is true? A. The tippy is liable only if he financially benefited directly from the tipper. B. Tippy liability depends on whether the tipper breached a fiduciary duty and the tippy knew. C. Tippy liability applies automatically if the investor trades within 24 hours after the tip. D. Tippy liability does not apply to tokenized assets. Correct answer. B. Tippy liability depends on whether the tipper breached a fiduciary duty and the tippy knew. Explanation. Under Dirks, tippy liability requires that the tipper breached a fiduciary duty by disclosing non-public info, and the tippy knew or should have known of that breach. Profiting from the tip confirms liability, but it doesn't require direct compensation. Application to tokenized assets is the same. Material non-public info gives rise to traditional insider trading liability under Rule 10b-5. Question 7. Under Rule 10b-5(1) trading plans, which condition helps an insider avoid allegations of trading on non-public information? A. The plan must specify trades at least 2 years in advance. B. The plan must be adopted in good faith before the insider is aware of material non-public information, at least 30 days ahead of the first trade. C. The plan may be terminated and restarted anytime by the insider based on market trends. D. The plan invokes automatic trading only if new board members are appointed. Correct answer. B. The plan must be adopted in good faith before the insider is aware of material non-public information, at least 30 days ahead of the first trade. Explanation. Rule 10b-5(1) permits pre-arranged trades that insulate insiders from liability if designed in advance, in good faith, and without influence from inside info. A 30-day cooling-off period before the first trade is considered best practice, though not mandatory. Plans terminated or restarted during periods of insider knowledge raise suspicion. Question 8. When a tokenized asset qualifies as a security under the Securities Act, what obligations apply to its issuer at the point of first sale? A. Must register under 1933 Act unless relying on an exemption, and provide a prospectus with material disclosures. B. Must apply to FINRA and list on a national exchange within 60 days. C. Must register under the Investment Advisors Act. D. Can rely on Regulation A+ and skip all compliance. Correct answer. A. Must register under 1933 Act unless relying on an exemption, and provide a prospectus with material disclosures. Explanation. Initial distribution of securities must be registered with the SEC under the 1933 Act unless an exemption applies, e.g. Reg D, Reg A+. An appropriate prospectus or offering circular containing required disclosures must be delivered. Registering under 1940 Act or listing on exchanges are separate obligations later. Topic mastery requires knowing the registration trigger and associated disclosures. Question 9. Ms. Lewis, CTO of FinDefi Corp., sees that her platform allows cross-border token sales that bypass U.S. requirements by claiming offshore users. She suspects this violates regulation. What regulatory principle is at risk? A. Integration doctrine prohibits combining Reg D and Reg S offerings. B. Regulation S safe harbor requires no U.S. market participants or solicitation. C. Issuers must register under the Exchange Act even for offshore offers. D. Reg S bans U.S. persons from using logos. Correct answer. B. Regulation S safe harbor requires no U.S. market participants or solicitation. Explanation. Reg S excludes offshore offers from U.S. registration, but only if no directed selling efforts or offers in the U.S. and no U.S. persons participate. Violation exposes the issuer to full 1933 Act liability. Tools to exclude U.S. persons, IP filtering, and know your customer procedures are critical. Question 10. To comply with SEC guidance on digital tokens, which factor tends to push a token toward being classified as a security rather than a commodity? A. It underlies a tradable commodity. B. It is sold via initial issuance with profit expectation based on third-party effort. C. It uses utility within a decentralized fitness app. D. It is listed on exchanges not registered with FINRA. Correct answer. B. It is sold via initial issuance with profit expectation based on third-party effort. Explanation. The Howey test determines a security if there's an investment of money in a common enterprise with expectation of profit from the efforts of others. While commodities like Bitcoin don't pass Howey, many tokens crafted with promise of future gains, often marketed to investors, fail under Howey. The exam tests nuanced application of that standard. Question 11. A broker-dealer uses an AI-driven algorithm for client trade recommendations. The firm must evaluate whether it qualifies as investment advice under the Advisors Act and FINRA rules. Which factor is most determinative? A. Whether the algorithm uses blockchain data. B. If the recommendation is personalized and the firm receives a transaction-based fee. C. If the algorithm provides only historical trading volume stats. D. If the client uses a mobile app interface. Correct answer. B. If the recommendation is personalized and the firm receives a transaction-based fee. Explanation. Under both the Advisors Act and FINRA's suitability rule, personalized investment recommendations tied to transactional fees make it investment advice. If advice is generic and impersonal, it may not qualify. The difference matters because advisors owe a fiduciary duty and must register, while broker-dealers are held to suitability and Reg BI standards, distinct compliance regimes. Question 12. Ms. Thompson, a FINRA-registered broker, receives a large odd-lot order for an illiquid IPO. Her algorithm segments it into slices, each priced slightly higher to simulate increasing demand. The client's goal is to execute the total order, but this strategy modifies the bid-ask profile. How should she proceed? A. Proceed. This is best execution under Reg Buy. B. Cancel. The activity is layering, a form of market manipulation under Rule 10b-5 and Rule 9b-1. C. Pre-clear with FINRA for algorithmic execution. D. Inform the client silences are normal for small trades. Correct answer. B. Cancel. The activity is layering, a form of market manipulation under Rule 10b-5 and Rule 9b-1. Explanation. Layering or spoofing involves placing orders to create a false impression of demand, then canceling them. This violates Rule 10b-5 anti-fraud and FINRA Rule 5210. Even in pursuit of best execution, manipulation is disallowed. Traders must avoid order book behavior that deceives other market participants. Question 13. When must a FINRA member firm electronically report details of customer orders to the Consolidated Audit Trail, CAT? A. Whenever a mutual fund is purchased. B. Only for orders executed in national markets and market-linked executions. C. For all orders executed, including internal matches, cancellations, and modifications. D. Only for orders placed by institutional clients. Correct answer. C. For all orders executed, including internal matches, cancellations, and modifications. Explanation. Rule 613 of Reg NMS requires detailed logging of all orders across marketplaces and internalization, plus modifications cancellations. CAT facilitates post-trade surveillance by the SEC and FINRA. Knowledge of full traceability is crucial for modern securities compliance. Question 14. How does Regulation SCI require trading venues to ensure system resilience? A. Self-certification with peer review. B. Implementation of robust disaster recovery, capacity planning, and penetration testing protocols. C. Monthly API performance reporting. D. Full blockchain migration for transparency. Correct answer. B. Implementation of robust disaster recovery, capacity planning, and penetration testing protocols. Explanation. Regulation SCI mandates SEC-covered entities maintain high operational standards, holistic testing, incident response, change management, etc. It does not require blockchain migration, but emphasizes traditional systems reliability for modern trading. Question 15. Mr. Nguyen, General Counsel at Acme Corp., contemplates a tender offer to buy 30% of Navigator Inc.'s shares. Which preliminary legal action must Acme undertake before launching the offer? A. File Schedule to under the Williams Act within 10 days after announcement. B. File Form 13G for any shares bought. C. Use Form S-1 to register all securities sold. D. Obtain FINRA approval for insider trading exceptions. Correct answer. A. File Schedule to under the Williams Act within 10 days after announcement. Explanation. Under the Williams Act, any offer to acquire 5% must file Schedule to at least when the first offer is communicated to shareholders. This provides detailed disclosure regarding the offer terms and financing. 13G is for passive investment, irrelevant here. It's critical for compliance to the tender offer framework. Question 16. A company plans a reverse triangular merger via Rule 145 and will issue replacement stock to acquire a private company. What securities law requirement is most relevant to the stock exchange? A. Rule 701, Shareholder Notification. B. Registration of the exchange of shares, unless an exemption applies. C. Exclusive issuance of fractional shares only. D. Requirement that both stocks be mortgage-backed. Correct answer. B. Registration of the exchange of shares unless an exemption applies. Explanation. Rule 145 treats certain corporate events, including mergers and stock acquisitions, as securities offerings under the 1933 Act. Thus, companies must register share exchanges or find an applicable exemption, e.g., where shareholders consent or use Rule 145(b). The rule ensures shareholders receive disclosures in transactional contexts. Question 17. Under Reg BI, how must brokers handle conflicts of interest when offering margin lending or revenue-sharing products? A. Disclose them in writing and mitigate them. The firm must not place its own interests above the customer's. B. They can avoid disclosure if revenues are less than 5%. C. They may require clients to sign a waiver, exempting the broker from conflict rules. D. Conflicts are allowed only if approved by the local exchange. Correct answer. A. Disclose them in writing and mitigate them. The firm must not place its own interests above the customer's. Explanation. Reg BI requires 1. Disclosure, 2. Care, 3. Conflict of interest mitigation, 4. Compliance. Revenue sharing or margin can incentivize brokers to act contrary to customer interests. Full disclosure and adequate policies, e.g., incentives, caps, supervision, are mandatory. Waivers are not permitted. Question 18. Ms. Carter, a compliance officer at a FINRA firm, discovers a pattern of matched orders between internal accounts that boost apparent trading volumes. Customers may see a distorted activity profile. What is her best course? A. Report to FINRA. Cease matched orders immediately and remediate customer disclosures. B. Increase marketing to counterbalance volume drop. C. Convert matched orders to off-market trades to avoid detection. D. Place matched orders anonymously via other brokers. Correct answer. A. Report to FINRA, cease matched orders immediately, and remediate customer disclosures. Explanation. Matched orders to inflate trading volume violates FINRA Rules 5210 and 2020, and Exchange Act Rule 10b-5, manipulative. Firm must self-report, cease the conduct, and take corrective action regarding misleading disclosures. Silencing or moving the behavior elsewhere is not compliant. Question 19. What is a key distinction between open-end and closed-end investment companies under the Investment Company Act? A. Closed-end companies are exempt from valuation rules. B. Open-end companies redeem shares daily at NAV, while closed-end shares trade on secondary markets at market prices. C. Closed-end funds can never invest in derivatives. D. Open-end funds require SEC yearly review only. Correct answer. B. Open-end companies redeem shares daily at NAV, while closed-end shares trade on secondary markets at market prices. Explanation. Open-end funds, mutual funds, offer redeemable shares with price equal to end-of-day NAV. Closed-end funds issue fixed shares that trade at a market-driven premium discount. Proper classification affects how funds comply with liquidity, valuation, and pricing regulations. Question 20. Under MiFID II and Regulation ATS, U.S., what key transparency obligation applies to alternative trading systems? A. Must publish daily block trade volume. B. Must provide pre-trade appropriately and post-trade information to regulators. C. Must use blockchain settlement. D. Must allow margin lending directly on the ATS. Correct answer. B. Must provide pre-trade appropriately and post-trade information to regulators. Explanation. ATSs like US ECNs and EU MTFs are required to publish transparency data, order book depth, pre-trade and executed trades, post-trade. This supports market integrity and price discovery under Reg NMS, MiFID II, and Reg ATS. Question 21. Mr. Davis, lead counsel for a SPAC bringing a private biotech firm public, learns the target negotiated a 20% equity clawback triggered by missing revenue targets. How should he treat this in the proxy? A. Disclose it as a material component of the merger agreement in the Schedule 14A. B. Exclude it as immaterial because it's contingent. C. Address it only in Form 13F disclosures. D. Abstract out the terms and present only aggregate equity percent. Correct answer. A. Disclose it as a material component of the merger agreement in the Schedule 14A. Explanation. Under Regulation 14A, SPAC proxy disclosures must include all material terms that affect shareholder voting, including contingent equity adjustments like clawbacks. Omission or hidden disclosure invites SEC attention and potential litigation risk. Contingent payments are as material as any guaranteed payout. Question 22. Under Rule 144, what limits apply to a non-affiliate selling restricted securities? A. Sales must be registered. B. Subject to volume limits based on the average trading volume of the prior 4 weeks, subject to 6-month holding period. C. No restriction for public companies. D. Must be sold via intrastate exemption only. Correct answer. B. Subject to volume limits based on the average trading volume of the prior 4 weeks, subject to 6-month holding period. Explanation. Rule 144 allows non-affiliates to resell restricted securities after a 6-month holding period for SEC reporting issuers, subject to volume limits, the greater of 1% of outstanding shares or the average weekly trading volume in the preceding 4 weeks. Affiliation adds further constraints. Question 23. How does Regulation Best Interest, Reg BI, affect broker-dealers when executing complex fixed-income securities for clients? A. They must always route orders through SEC-regulated ATS. B. They must assess reasonable alternatives, document suitability, and place the client's interest ahead of their own. C. They need only comply with federal suitability rules. D. They can rely on FINRA rulebook only. Correct answer. B. They must assess reasonable alternatives, document suitability, and place the client's interest ahead of their own. Explanation. Reg BI imposes a best interest standard, requiring brokers to use reasonable diligence, care, skill, and prudence in making recommendations, to identify and disclose material conflicts, and to mitigate them. In fixed-income assets, execution also requires a strong framework to ensure client interest is primary. Question 24. Ms. Morgan, corporate counsel for a company merging into a subsidiary, recognizes the transaction is reclassification under Rule 145 and triggers shareholder rights. She is evaluating who must receive disclosure. What should she advise? A. Only controlling shareholders. B. All registered shareholders and beneficial owners entitled to vote, with Schedule C or 14A. C. SEC only and not shareholders. D. Only insider shareholders and board members. Correct answer. B. All registered shareholders and beneficial owners entitled to vote, with Schedule C or 14A. Explanation. Rule 145 requires proxy disclosure to all shareholders entitled to vote on reclassifications, such as mergers. Schedule 14A for solicited proxies or 14C for no action required mailings must be provided. Omission creates material misstatement lack of disclosure. Question 25. An issuer adopting SOX Section 404 internal control must evaluate its internal reporting processes related to digital asset holdings. which procedure is especially important? A. Daily password rotation. B. Segregation of duties between Oracle setup and custodian signatories. C. Only validating custodians daily via bank statements. D. Only using paper records for crypto. Correct answer. B. Segregation of duties between Oracle setup and custodian signatories. Explanation. SOX 404 requires internal control over financial reporting. When dealing with digital asset oracles, price feeds, and custodial access, separation of duties prevents a single actor from manipulating both data price and transfer authority, key to ensuring accurate financial statements. Question 26. How does the Investment Company Act define senior securities, and why does open-end fund leverage matter? A. Senior securities include non-voting stock. Leverage is irrelevant. B. Senior securities include debt, preferred stock, and leverage. Open-end funds must limit leverage to 300% of net assets. C. Senior securities include only derivatives, so funds arbitrarily use them. D. Senior securities are obsolete under current rules. Correct answer. B. Senior securities include debt, preferred stock, and leverage. Open-end funds must limit leverage to 300% of net assets. Explanation. Under Sec 18, senior securities are obligations senior to or on parity with the issuer's most subordinated equity. Open-end funds using leverage are considered issuers of senior securities and must limit total leverage, including borrowings and forward commitments, to 300% of net assets. This regulatory ceiling protects investors from excessive risk. Question 27. Mr. Lin, CFO of a U.S. company planning a cross-border tender under foreign private issuer rules, is reviewing Form 6K obligations. After the tender completes, what documents must he file? A. Form 6K for current reports including tender results, and possibly Form 20F at year-end with full details. B. No filing, since the action is non-material. C. Form S1 to register the tender. D. Tender reports only under local home jurisdiction. Correct answer. A. Form 6K for current reports including tender results, and possibly Form 20F at year-end with full details. Explanation. Foreign private issuers use Form 6K to submit material non-U.S. documents, e.g., tender offer results. Form 20F at year-end then compiles full disclosures. This satisfies SEC cross-border compliance without duplicative SEC-registered offerings. Question 28. Under Dodd-Frank, which SEC whistleblower disclosure is protected? A. Any consumer complaint filed with FINRA. B. Original information regarding a securities law violation that leads to a successful enforcement monetary sanction over $1 million. C. Anonymous tips only without documentation. D. Information unrelated to securities laws. Correct answer. B. Original information regarding a securities law violation that leads to a successful enforcement monetary sanction over $1 million. Explanation. The Dodd-Frank whistleblower program protects participants who submit original, credible, and actionable information that results in SEC enforcement with over $1 M in sanctions. The SEC provides monetary awards and prohibits employer retaliation. Routine complaints do not qualify. Question 29. Why might a platform token, initially classified as a utility token, become a security over time? A. Because token symbols expire. B. If the token begins trading with expectations of profit tied to third-party efforts, it may satisfy the Howey test. C. Utility tokens must automatically register after 1 year. D. Tokens on Ethereum mainnet are always securities. Correct answer. B. If the token begins trading with expectations of profit tied to third-party efforts, it may satisfy the Howey test. Explanation. Regulatory Guidance (SEC) FINRA notes that token classification is function-based and dynamic. If utility tokens evolve, begin offering passive returns, governance rewards, or speculative profits, they risk crossing the line into unregistered securities. Issuers should monitor post-launch evolution carefully. Question 30. Ms. Patel, advising a tech firm seeking to issue tokenized debt securities, notes that token holders will receive periodic interest payments and automatic redemption at maturity. What must the issuer do to comply with U.S. securities law? A. Register the offering under the Securities Act, disclose material terms, and list it in a Form S-1 or Reg A+, or rely on a valid exemption such as Rule 144A for qualified institutional buyers. B. Use Reg CF to let retail investors purchase tokens. C. Classify as OTC token and proceed tokenization without SEC notice. D. Issue as utility tokens since they are digital. Correct answer. A. Register the offering under the Securities Act, disclose material terms, and list it in a Form S-1 or Reg A+, or rely on a valid exemption such as Rule 144A for qualified institutional buyers. Explanation. Tokenized debt securities offering interest and redemption clearly represent debt instruments. They qualify as securities. Proper SEC registration via S-1, Reg A, or 144A private placement is mandatory unless an exemption applies. It ensures comprehensive disclosure to token holders, a core securities law requirement.